What's up, guys? It's Migs with Market Open, back at you with another Mentorship Monday session. Today I wanted to cover a topic that I get asked quite a lot, why I trade a certain type of stock. So I actually wanted to put out some of the facts out there, and I try to make this as non-biased as I could. I sat there with a couple of my friends, for the past like 30 minutes or so, trying to come up with different pros and cons of between large caps and small caps. So obviously, if you guys know, or if you guys are part of my channel, you guys know what kind of stocks I trade. But I'm just gonna go ahead and put the facts out there. I'm not gonna say it right off the top of the, I guess at the beginning of the presentation, but I'll kind of leave it to the end. But remember that I try to make this as non-biased as I could, and I really try to come up with the best pros and cons of both of them. All right, so let's go ahead and get started with the presentation. All right, so small caps versus large caps. Now, so let's start off with the small caps first. Small cap is a market cap for the company anywhere from 300 million to 2 billion. So some of the pros for small caps are that they are cheap. Obviously, they are lower priced, so there's a lower barrier of entry. So basically, any 18-year-old with $1,000 or $500 or whatever in a Robinhood account can get into the stock market and start trading these right away, because there are stocks that are under a penny, up to like around $10 or so, 10, 15 bucks. Some of those companies are actually still considered small caps, but typically they're companies under $10. So they're cheap. Also, a lot of those companies don't put out a lot of shares to be traded, so which means that they are low float. Low float meaning that there is a small amount of shares that are able to be traded, so which makes them very volatile. It's just the imbalance of supply and demand. So for example, if you put out a small pharmaceutical company that says that they have phase 3 approval from the FDA and there's not a lot of shares to be traded, obviously a lot of people want those shares, but if there's only 500,000 shares out there to be traded, something with an extremely small float, that is something that can make really fast moves, so aka being very, very volatile. Also, another pro is that they can be manipulated if that's your sort of thing. I know that there's chat rooms out there that like to front run their members, and by front running I mean that they buy into a stock before their chat room does, and then they tell everybody else in the chat room to get in, and then which drives the price up, and then they hop out, and then they tell their members to get out. That's what front running is. Some people have been busted for it. Some people have been busted for manipulating. Like there's a lot of people on Twitter that have a lot of power. Not necessarily the president either. I'm just talking about like just chat rooms and other gurus and stuff, but not going to mention any names. But yeah, there's definitely a lot of manipulation going on in small caps. If that's your sort of thing, which it's kind of sketchy, but that's on you. Now, some of the cons, with a lot of the small caps, there is a lack of volume, so there is not as many traders involved, because most hedge funds, most prop funds are not allowed to buy stocks under $10. Obviously, there are some out there that still invest in stocks under $10, but and the majority of them are not allowed to invest in those sort of small caps. So with that, also without institutional traders, there is a lack of rules. So which means that you're most likely trading against retail traders, which are traders like you and I, or your neighbor, or somebody else down the road that's not necessarily quite educated on how to trade the stock market, what are the best rules and practices to try and get in. So it's kind of, I like to refer to it as a Wild West. Also, before I go any longer, I would like to point out that for my first year, so I've traded stocks for about 2 years now, and for my first year I actually traded small caps, so I do know what I'm talking about. I've been in that, I was in that world for the first year, and then I had made some changes in the way that I play. So the first year I have traded small caps, so it's not like I don't know what I'm talking about when I'm talking about volatility and all these small caps and float and all that stuff, because I used to play them all the time, and I still sometimes do. Now, moving on. So no crystal ball advantage. So let me explain that a little bit. The currently um, professional, well, not currently, but professional traders use the SPY, which is the top 500 companies, which is the S&P 500, to be able to read the sentiment of the overall stock market during the time that they're making their trades. So if the stock market's going up, you most likely want to go with the trend and go long. If the stock market's headed down, you most likely want to take shorts and bring those down as well. So now that you have the market in your direction, and so that helps. But now, small caps do not follow the S&P 500 as much because those companies are not listed on there. They do take some sort of, I guess, not what's it called? They do catch some sort of backwind, I guess, from the S&P 500 because some of those companies, the small caps, are related to some of the companies that are being affected within the S&P 500, and they do catch some sort of movement from it, but they're not as directly impacted. Obviously, I do know that the IWM does exist, which is for the basically the same thing but for small caps. But remember that a lot of these small caps are running on hype. They're running on some of them are running on manipulation. If I had a nickel for every time I've seen a small cap get manipulated because of like just some random tweet, but also these small caps are running because of low float and just different things that like different catalysts as well that don't really have too much an effect or in congruence with the IWM, which is going a certain way during that time. So it doesn't have as much impact. Also, another thing is that it is hard to find shorts. During my first year of trading, I was trading small caps, and I always remember either A, not having shorts, or B, running out of shorts from the broker and them not being able to borrow. Because if you have a small cap that has a low float, which means that they have a low amount of shares to be traded, the broker only has so many shares that they can borrow out for you to be able to short. So, and on top of that is that it's actually there is a fee for borrowing the short, so it's actually a little bit more expensive to short large amount of shares for the small caps. And then also, if you have per share commissions, obviously it's kind of expensive commission wise. So if you're trading 1,000, 2,000, 3,000 shares, the commissions do add up. So if you're paying, I don't know, 5 cents or so per share, or 2 cents or 1 cent or whatever, it doesn't really matter, you know. It's per share commission structure is a lot more expensive because you're trading such large amounts. Okay, so moving on to large caps. So large caps are stocks considered anywhere with a market cap of 10 billion up to 200 billion. Some of the pros, so it comes with a set of rules. Like I was saying earlier with the hedge funds and prop funds, they trade stocks that are over $10, which are typically larger cap stocks, which also include medium cap stocks. So because as long as they're over $10, then they're fair game. So it does come with a set of rules. Now, when I say rules, I don't mean per se, hey, you know, you buy this sort of dip, or if this pattern plays out, you know, you buy it here or there. But if you think about it, the institutional traders that are in hedge funds and prop funds, they're 80% of the volume. That is a verifiable fact. The institutional money, which also includes algorithms and computers and all that stuff, but they're programmed to trade a certain way, and they make up 80% of the money in the markets, which is also the volume. So if they are all trained a certain way, and somebody that is in a prop fund or a hedge fund kind of steps down and becomes a retail trader and just trades for themselves and then just starts teaching other people to learn how to trade just like the professionals do to be able to make money off of it. If you think about it, if you want to trade like a professional, just get somebody that's a professional to teach you the rules, and you should be good to go, you know, ideally speaking. Now, also, like I mentioned earlier, there is more volume in the larger caps because there's more institutional money. Obviously, institutional money is involved. Okay, so also, the next pro is that there are normal investors that are in these stocks. So if you talk to, I don't know, maybe your neighbor or somebody down your street that wants to invest in the stock market long term, they're most likely going to say, I want to get into Apple, I want to get into Facebook, I want to get into Tesla, Nvidia, or something like that, one of the larger cap stocks. You'll never hear them say, oh yeah, I'm really going to invest in CLSN or CLSD, or I forgot exactly what it was. Or actually, just to rewind back a couple of months, I remember there were a lot of people that were seriously thinking about investing long term into HMNY. HMNY is one of those like iconic stocks that has ran for such a long time, and it's just most of the times it just kind of runs on hype. It goes up and it just crashes back down all the time. So probably a few times a year. Same thing with DRYS. There's a bunch of shipping stocks that have hit rock bottom, and people have seriously thought about investing tens of thousands, if not hundreds of thousands, into such a piece of crap stock that is just gonna most likely end up just crashing and burning and going back to zero, really where it belongs. With the larger volume and then the larger float also comes easier to get shorts. So if you want to short Facebook, your broker has plenty of Facebook shares for you to borrow. So if you want to short 100,000 shares of Facebook, I mean, obviously that might cost you a pretty penny, but they do have a lot more shorts for you to be able to borrow. Also, another one that I kind of snuck on here, but it is a very valid point. Larger caps also get more exposure in TV and radio. So we all know the bald guy on TV that loves to scream out like buy, 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 sell, sell, sell. And you guys know exactly who I'm talking about. So obviously a lot of these caps that they're covering on TV and on the radio are larger cap stocks, larger names, McDonald's, Walmart, Apple, Amazon, those sorts of things. And so if more people hear about them doing well, more people are going to want to get into it, therefore kind of backing up the larger volume. Another pro is also the commission structure. Obviously, that only applies if you have a per share basis with your broker. But if you have something like TD Ameritrade where it's like $4.65 or $4.99 or whatever they have currently per trade, then it doesn't really matter. So it would be even. But if you're trading on a per share basis, then commissions are a little bit cheaper for you. Now, some of the cons. If you notice, this is basically the exact opposite of what the pros are with the small caps. So obviously, it's more expensive. So buying 100 shares of Facebook is obviously more expensive than buying 100 shares of DRYS. And also, they are not as volatile. Most of them are not as volatile, although there are still some low float names that that have minimal shares to be traded, but that are more expensive. So this is my number one reason why I started trading large caps and I started moving over from the small cap world. Like I said earlier, I try to make this as non-biased as I could. I seriously sat down with a friend of mine on the phone for like 30 minutes trying to come up with these, and we just really couldn't come up with any more reasonable ones. We try to think a little bit outside the box, but all the ones that are mentioned are verifiable facts that you can look up yourself, and that will back up what I've said earlier. So anyways, back to the number one reason, and my number one reason for trading large caps is it is easier to get 50 cents to $1 out of a large cap than it is a small cap. That's it. It's very simple. If you have the funds to be able to trade larger caps, and you don't even really have to have that much money because there's leverage out there. I think average leverage in the US is like 4-to-1. If you go out to the Bahamas, it's 6-to-1, and if you go to CFDs, it's like 20-to-1. So you don't even really need to have that much money to trade large caps. You would be fine with trading anything under 500 shares in the large cap world. But like I mentioned on here, it's a lot easier to get 50 cents of $1 than it is to get out of something that moves 30 cents to $1, because the chances are for you to catch the exact bottom and the exact top is almost impossible. Like it's very, very, very hard to try and call the bottom and top of these stocks. So the best that you can do to try and stay consistent is just to grab a small piece of the move consistently, day in and day out, and you'll be able to see those consistent gains. I'm not trying to drive a Lamborghini tomorrow, like maybe one day, but this is a long-term plan for me to be able to stay in the stock market for a very, very long time and many years to come. So I just see that as the safer, more logical way for that to happen and for me to be able to stay in this game. So I hope you guys enjoyed that presentation. Let me back out of this real quick. There we go. So I hope you guys enjoyed that presentation. If you guys do have any other pros and cons for either small caps or large caps, be able put that below in the comment section. And then, kind of share ideas in the comment section and see what, something else that I might have missed. Like I tell you guys, also, if you guys have any questions, make sure to put it down in the comment section below. And also, the Facebook group is in the description box below. We're up to 5,500 members. That's where I share my watch list with you guys every single day, and we have different people from like investors. There's cryptocurrency traders in there. There's day traders, swing traders, long-term investors. There's all sorts of people in the group, and we're kind of able to share ideas with each other and have different calls. So it's completely free to join. Just make sure to click on the link below. And I guess that'll do it for another Mentorship Monday. I'll talk to you guys tomorrow. Bye.